Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The stock market has had a great run in 2023, but that means that a lot of companies that are actually relatively weak financially have actually seen their stocks rise. And there are a few that I think are really getting overvalued, and investors should consider twice before buying them. I'm going to cover 4 that I think we should avoid at all costs today. My name's Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content and check out my newsletter, Asymmetric Investing, and I'll link to that in the show notes. The first stock that I want to go through is Wayfair. And here's a chart. I'm going to show the same data for all 4 of these companies, but you can see the market cap is now $8 billion. Total debt is $4 billion and negative cash flow from operations, $600 million in the last year. I would argue this is actually one of the companies that benefited most from the pandemic. You can see that the trend line was that they were losing more and more money going into early 2020, and then that completely reversed. They became a great place to shop as a lot of other places were closed, and it was really hard to get furniture. If you were out buying furniture for anything, whether it was your home, your office, outdoors, it was very difficult to get furniture. That means that Wayfair had more ability to price their products at a higher price point, generate more margin, and you can see that profitability and cash flow came as a result. But that has absolutely reversed as the pandemic has ended, and now the company is going back to negative cash flow. The question for long-term investors is this a business that is ever going to be cash flow positive? I think the real challenge with something like furniture is it's very expensive to ship. So shipping things individually to customers is going to be really expensive. A lot of their competitors are shipping a semi-full of product that's then going to a warehouse and delivered specifically to customers. So it's not UPS delivering this and charging a premium for delivering furniture. Or I've had giant trucks deliver a couple of fairly small boxes from Wayfair. It actually looks really silly when they pull up and just have a couch in the back. So from a really fundamental basis, I think this company is not built to be profitable long term, and that really shows in the numbers. So this is a stock that has recovered recently, but I think it's absolutely one that I would avoid given the operating trends that we see right now. The second one is Foot Locker, and this is one where they again benefited from the pandemic. You can see that cash from operations, free cash flow, was actually relatively positive during the pandemic. But now that has reversed. The company has $3 billion worth of debt. And I just wonder what the competitive advantage is for Foot Locker over any of its other competitors. Its suppliers can actually go straight to customers. If you want to buy Nike shoes, you might as well just go straight to Nike. They're going to have the best selection and the first availability of all of their shoes. So why do you need to go to Foot Locker? They're also a specialty products company, but they have relatively limited inventory. If you're looking for sporting goods in general, why not go to Dick's? If you're looking for a pair of shoes, but you might be looking for other things, why not go to Target or Walmart? The competitive pressures are just not in the favor of Foot Locker at this point. People are not going to malls in the same way that they used to. That's where most of the company's stores are. And so a retailer like Locker just doesn't have the same tailwinds that it has had for quite a while. I don't think there's a lot of value there. And given the negative free cash flow and the debt on the balance sheet, this is a stock that I would stay away from. The third one is Blink Charging, and there's just simply not a lot to like about Blink Charging. They're selling a commodity, electricity, through a commodity plug, a standardized plug, whether that's any of the plugs that they have is not something that is proprietary to them. It's a standard, and they're competing with every other charger that has standard plugs selling the same commodity. Not a great strategic position to be in. Now, I know that there's a lot of people who think there's going to be a lot of growth in electric vehicle sales, and therefore we need more chargers. But the reality is that this is not a high margin business, and there's nothing differentiating them. So look at the free cash flow and operating cash flow numbers. As Blink Charging has grown its revenue, its losses have gotten bigger. Its cash burn has gotten worse. As a result, the stock has dropped. There's not debt on the balance sheet, but there's a real question of how is the company going to raise money in the future as it continues to burn cash? As that market cap drops, it's harder for Blink Charging to both raise debt and raise equity through selling stock. So I think it's kind of backed into a corner. A lot of these charging companies are in a very similar position. This is not a company that I think has profitability in its future or positive free cash flow in its future. And as a result, it's just one to avoid. And the final one is Beyond Meat. Great idea making meat that is not actually made from meat. But again, the story and the reality are very different. You can see the cash from operations is negative, free cash flow is negative. There's also debt on the balance sheet. There's more and more competition coming into the market. More and more information is coming out about how healthy Beyond Meat's products are, until Beyond Meat shows that it can make a consistent profit. Have products that are consistently in stores and people buy over and over again. This is not a stock that I would buy. One of the challenges in a product like this is that your initial sales are actually just people filling grocery shelves. That can actually drive a lot of sales, but you have to have demand through the end customer. And I just haven't seen the kind of adoption that you would like to see for Beyond Meat, whether that's in grocery stores, whether that's in fast food chains, who frankly are going to have a lot of pricing power over Beyond Meat. But until there's proof that there's real financial viability for this company, for its products, return on the hundreds of millions of dollars in manufacturing assets that it's built, I have to question what the future of this company is. So maybe a company that would be interesting to own in the future, but for now, that cash from operations, that negative free cash flow, the debt that's on the balance sheet is just too much risk for me to take right now. So the 4 stocks that I would avoid: Wayfair, Foot Locker, Blink Charging, and Beyond Meat. What do you think about those 4? Do you agree or do you disagree? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.